Kudos to Bix Weir. Shout out to Bix Weir on this catch that he found. Shout, let it all out for Bix Weir. So he finds this article on Bloomberg. He sent out an email. Good spy versus bad spy in the DTCC stock share con is messy. DTCC, the Depository Trust Corporation Clearinghouse, or whatever the hell it's called, Clearing Corporation. Do you remember Hurricane Sandy? I know I've discussed this when it happened. And the storm was going up around New York and was curving off to the right, and then left hook hits New York in the DTCC building known as Seed & Co. It's a fictitious corporation that every single share in the world, when you buy a stock, they're the owner of it. They're actually the owner, not you schmuck. It's a fictitious name. They keep the ledger and everything else. And we all asked, why would that building need to flood? Because they said it sustained serious damage. Documents within the vault, $36 trillion worth of documents that it housed. Quite a bit was damaged significantly, they said. And the kicker, which that was already enough to let me know this was not an accident. You don't have $36 trillion vault with that much money in it, or items worth that much money in it. And you're not going to convince me, even kind of, that it's not fireproof and floodproof. I mean, it's not happening. But I think someone left the vault door wide open, and it flooded because Hurricane Sandy flooded the streets of New York. And when they were cleaning up the mess, a fire started, causing more damage to more documents. If you believe that, I'm going to call you to your face now. You are a freaking idiot. You are a jackass. I will say that. And the good news is I know none of you believe the opposite. In other words, that it's true. This was an inside job of some sort. And I said, I don't know the real full reason yet of why they did this, but I suspect in the next crash we'll find out the reasons why, because they're going to be, we want to see that, and they're going to say we don't have it. That, and we'll have to see, well, specifically what don't you have? Then we'll know why they did it. The storm, the hurricane, I remember watching this girl's YouTube channel. She was watching the next rad radar things, and it showed like 4 or so massive straight line cloud tube looking things heading in the direction, the exact precise direction that the storm all of a sudden made this curveball the next day and went toward as if it followed this nice little comb of lines. Giant chemtrails showing up as clouds because they're so thick. Oh, okay. And it pulled the storm. It's my opinion. Yes, conspiracy. But I saw it. And that place got flooded. And you're not going to convince anybody in the world that a vault with $36 trillion worth of assets in there accidentally got left open or just wasn't strong enough to withstand water coming in. Yeah, okay. So Bloomberg has an article that he posts, Bix Weir, and it explains a few things. This is a fantastic explanation. Bix Weir, you are the man for finding this and sharing this. Bloomberg, Wall Street, Dole Food, the company, had too many shares issued. What? How? How could there be more shares than what there is? A claim that Bix has also made. That all these shares and companies, they've produced extra shares that don't even really exist. Kind of like with the gold and the paper futures. They have all these contracts backed by one thing. This should be 1-to-1, but it's 100-to-1, 200-to-1. They've been doing, not to that extent, I don't think, but they've been doing it with the shares of many, many companies. And here's a perfect example of just how it could possibly happen. In 2013, tropical fruit tycoon David Murdoch, who was the chairman, chief executive officer, and biggest shareholder of Dole Food Corporation, took it private for $13.50 a share. A lot of shareholders felt that the price was way too low, and that Murdoch had sandbagged the shareholders by driving down the value of the company so he could buy it cheaply for himself. So they sued, and they actually won. In 2015, the Delaware Chancery Court ordered Murdoch to pay shareholders an additional $2.74 per share plus interest. There was a class action on behalf of shareholders covering 36.7 million shares. And after the court ruled in their favor, the class lawyers informed the shareholders and asked them to submit a form to claim their $2.74 a share extra. They got back claims from 4,662 people for a total of 49.1 million shares. Should have only been 36.7. That figure substantially exceeded the 36.7 million shares. So, what happened? Two things. The first one is just pure pointless mess. Essentially, the one way everyone owns stock is, number one, and this is the DTCC's fictitious thing, number one, Seed & Co., and that's spelled C-E-D-E, by the way. Seed & Co., a nominee of the depository trust company, owns all the stocks in all the companies. Number two, DTC keeps a list of its participants, such as banks and brokers, who really own that stock and how much each of them own. And then third, the participants in turn keep lists of beneficial owners, people and funds, that's you and me and whatever, who really own the stock and how much of each of them own it. So if you own stock, what you really have is an entry. And folks, when I'm about to read you this article, parts of it, this is why I have nothing invested in any paper asset, period. Market, nothing. Oh, but the Dow, the 401ks are great. No way. Even though I really want to get in on First Majestic mining, silver. Maybe I can get in and out before all hell breaks loose. Anyways, but this is the prime reason I don't play the stock market, 401k, investment, pension. No. So if you own stock, what you really have is an entry, accounting entry, on your broker's database, in your broker's database, and your broker, in turn, has an entry in DTC's database. And DTC, Seed & Co., has an entry in the company's database of shareholders of record. If you sell the stock, your broker takes it out of your account at your broker, and DTC takes it out of your broker's account at DTC, and DTC adds it to the buyer's broker's account at DTC, and the buyer's broker adds it to the buyer's account at the buyer's broker. As far as the company is concerned, Seed owned the stock the whole time. Tell me that is not insane, first and foremost. If this all makes your head hurt, you are not alone. Sometimes it makes DTC's head hurt too. So, it goes on to talk about how the courts are like, well, we're not going to follow the trail, and we don't want the lawyers and them to follow it. Basically, DTCC, you need to follow the trail since you're essentially the custodian of all of it. You need to find out who owns what shares, because what happened was, like, the day before they went private with that whole thing, who was buying stocks, who was selling stocks, that has to be logged. And then the day after, which means anyone who owned it the day after that he sold he went private with those stocks. The day after, if you owned it, well, you're not entitled to the $2.74 increase because it was after the fact. So the people before that, they are the ones, but people were trading and selling the stock while this was happening. So when the class action thing happened, they sent the wrong people, the new owners of some of the shares, the additional money, when they shouldn't have, because it was the people who owned the share before that date who gets the money. So it's kind of a big mess. And it goes on to So it says it's kind of hard in that the brokers have to go back and figure out who actually owned the shares at that time, but it's their problem. The Delaware Vice Chancellor concludes that for him to figure out who actually owns the shares, or for the lawyers to figure it out, would be lengthy, arduous, cumbersome, expensive, and fundamentally uncertain, and functionally impossible to do in a practical or cost-effective manner. That sounds hard, so the lawyer suggested, and the judge approved, letting the brokers figure it out instead. So it says here, there might be lots of issues, but they won't be the court's problem. Good solution. But there is another problem that created extra dole shares. This is also a mess, but not a pointless one. It's a real economic issue, and also one that people seem to get emotional about, and it is short selling. So this put a spin on this I didn't even think about. Wasn't even aware of this. How could all these extra shares come into play? And again, as I explain this to you, be prepared to say, oh my God, there's no way, this can't be real. This does not work this way today. And the answer is yes, it does, which is why it should frighten you even more away from this paper system. Some quick background, the way short selling works is 1. Mr. A owns a share of stock. 2. Mr. B borrows Mr. A's share of stock. Mr. B sells that share to Mr. C. But now Mr. A and Mr. C each own one share of stock. Where there was only one share, now there are two. A phantom share has been created. Well, not really. The trick to balancing the books is to remember that Mr. B owes Mr. A share of stock because he borrowed it, remember? So Mr. B now owns -1 share of stock. There's a total of 1 share, 1 for A and 1 for C, and -1 for B. 1 plus -1, well, it's 1. It's no problem, right? He says, but what if you start to ask, and I reply, shh, just be quiet, it works. What if the company pays a dividend? Well, Mr. C physically possesses the share. Don't think too hard about that metaphor. So the company pays the dividend to Mr. C. But Mr. A also owns the share, and he wants the dividend too. But it's okay because Mr. B owns -1 share, so he has to pay a dividend. So he pays the dividend to Mr. A, because again, he borrowed his share without him even really knowing that. In practice, this is all intermediated through brokers, and Mr. A is unlikely to ever find out that his share was borrowed or that he got his dividend from Mr. B for Mr. A. The whole thing just works quietly and seamlessly. It's magic. What if the company is acquired in a management buyout for $13.50 in cash? Same thing. The company sends $13.50 to Mr. C. Mr. B sends the $13.50 to Mr. A. The two owners of the 1 share of the stock each get the full $13.50 merger price for that 1 share of stock. Mr. B, who is short 1 share of stock, pays 1 merger price. Everything works. It just works. It's still magic. What if the company is acquired in a management buyout for $13.50 in cash, and then 3 years later a court adds another $2.74 in cash to the merger price? Wait, I have no idea, he says. The magic might break down here, as the court points out. The shorting resulted in additional beneficial owners who received the merger consideration, who fell within the technical language of the class definition, and who could claim the settlement consideration. Meanwhile, the lenders of the shares, not knowing that the shares were lent, also could claim the settlement consideration. This is another means by which 2 different claimants could submit facially valid claims for the same underlying shares. That's basically true of the original merger. So when it goes on, how I end this, remember, Mr. A owned the share. Mr. B borrowed the share. Mr. A has no idea his share has been borrowed. Magic you can do with a broker. Mr. B sells the share to Mr. C. Mr. C actually is the only one who owns it right now. Mr. A thinks he owns it, doesn't really, but on paper he still does. But Mr. B is now required to pay, because he was short and he sold it, he now owes Mr. A the price that he sold it to Mr. C. Okay? So in this case, $13.50. The article goes on to say, especially in something like this, brokerages could be already long gone by the time the class action happens. They're gone. You can't track down who owned what. It's too late. Because of that, they're gone, which means A, who thought the whole time, I've got this share, finds out last, your share was borrowed by this guy sold it to this guy, then we had the class action, but it was so late in the class action that the brokerage that originally handled the transaction is now gone. This guy owes you the additional money, but this says he doesn't have the money. His account's already been closed. He's gone he's gone. And you're going to sit there and say, hold on. I bought a share of a company through you in my name, and then you're going to find out, sir, it's never in your name. It never was and never will be. It went in our book as an accounting entry, who then went into the DTCC's book as an accounting entry, who went to Seed & Co. as an accounting entry, and they're delayed many times days apart before they all update themselves, if you will, and it can cause a problem. So essentially, Mr. B goes bankrupt, C got the share, your share, Mr. A, you're screwed. Good day. That is how it can happen. And I think of MF Global, kind of a similar situation. But at the end of this article, as it talks about all this, it talks about a good solution to dealing with that kind of problem. And I was surprised to hear the word blockchain technology in a Bloomberg article. If we had blockchain technology, all ledgers would be updated at the same time, and we would not have this issue. So while we still, in my opinion, but while we still would be able to have Mr. B, borrow Mr. A's and then sell it to Mr. C, the accounting would take place instantly, or within minutes anyways. However, what if something happens, big crash happens, Mr. B, his account's cleaned out, but he owes Mr. A the money. And the broker says, we got a lot of people in that position right now who just lost, and we're being told that they don't have the money. So now we're going to go bankrupt. We're filing for Chapter 11, whatever, 7, 11, take your pick, and have a nice day. And then you're going to be essentially John Corzined, if you will, like MF Global did. This is insane. When you go to the store and you buy something, you give them money, they give you an object, you take it home. With this rotten system, you're putting your faith in another person that has to put their faith in another system that has to put their faith in a final system. And the final system had a freaking hurricane come in and flood the freaking vault where all this is supposed to be stored at. And then a fire broke out as they were cleaning up the mess in a flooded vault. You ever seen fire? What happened? A bit major flood. Oh, then it caught on fire. Interesting. The question is, to me asking, what documents were damaged? Why did they do that? I'm pretty sure it has something to do with this kind of stuff. But could you imagine if all the big Dow Jones and S&P, all these companies, and this is just speculation, if it were found out that they had multiple shares issued above and beyond each and every share they're supposed to have had issued, and the club owned those extra shares and were making a killing because they realized, well, we've got the federal government who will keep the market stable at any cost. Guys, the stock market's going to run up. We're going to print additional shares and we're going to sell them. We can sell them by the freaking ton and it won't even phase the market because the plunge protection team, as we like to call them, the government will keep the market stable, which means we will get top dollar when we sell these extra shares. And then once we've sold them, we will have a flood take place in the vault, and then we'll have a fire take place after the flood to destroy all of our tracks. The excess shares will be gone, and it'll look back like, oh, everything's normal. Maybe that's why. So maybe we're not going to hear some court case in the future about it. We're just going to see that simply a bunch of these shares have vanished, and we didn't know about it anyways because the federal government through the Exchange Stabilization Fund, i.e. also the Plunge Protection Team, have been buying up all this crap anyways, and that's top secret anyway, so you don't get to know that, and it just goes under the rug somewhere. Maybe that was the point. I don't know. But I'm glad that I read that article because that explains a lot. And that is absolutely appalling and shocking to know that this happens and this is normal and it's allowed. You can borrow someone else's share, sell it to somebody else, they actually own it, and you have to pay the original guy. And if you happen to crap out on him, sorry about the original guy's luck. Imagine me. I want to play First Majestic Silver. I want some shares in your company. Oh, man, it's doing great. Oh, it's time to sell. Oh, sorry, Mr. J. Snip, the accounting problem. Whoa. What do you mean accounting? The shares you bought, it's in there. Oh, I know it's in there because I'm into my account right now and I see how many I own and I'm ready to sell. But you see the price today, I'm ready to sell. I tried to, it won't let me. And that's what I'm calling. Well, yeah, I know, we know. Your shares were borrowed out by somebody, another entity, sold off. They had a really bad position. They got a margin call on that position. They don't have the funds to give to you. They owe it to you. And I would sit here and say, whoa. I bought shares through you. It's mine. It's in your possession, but I bought it through your account. It's my account through you. Where's my shares? Again, we've got how the hell does that happen? I don't even know. But I got a feeling when all this goes down, the things that I'm talking about right now and have been talking about for other issues might just maybe, not even close to how horrible and the stories that we actually hear come out of what happened to certain people. And, this is my stock story, my shares, and this is what happened, and the absolute absurdity of it all. While I'll get to sit back and say, well, it's a good thing I only lost that such and such money from First Majestic, and I got my physical stack of silver sitting here protecting me. That makes it not hurt as much. I don't even know how. I read this and I just was like, this isn't real. Bloomberg.com. No, this isn't real. Bloomberg.com. This is not. They don't do fake articles. They don't do the Onion stuff. You know what I mean? This is Bloomberg. It's not possible that this could actually happen. Yeah, it is. But again, they end the video with what? Blockchain technology. What are the chances? Take care.